Hello everybody, my name's True Demon and I'm the Devil's Stockbroker. We had a bit of an unexpected but not so unexpected rally that occurred in the stock market today, with the S&P closing a little bit higher today at around $376.35. According to the stock market heat map, as you can see, that pretty much all across the board on the daily chart, we've seen electronics and tech push the market back to previous resistance at a level that we've seen just a few days prior, but still is fighting resistance at around the same area where Jerome Powell's speech took it down to earlier this week. The biggest movers in the sector were Nvidia, Microsoft, Google, and Meta, pushing the boundary and lifting the entire market back up to its previous levels of support, but still appears to be struggling. The members of Hell's trading floor may recall that when I stopped by in the trading floor yesterday, I was looking at the way that the market was behaving the day before, very close to the closing bell, and I had decided that, interestingly enough, the market was behaving in a way that indicated that it needed to retest a previous level of support that has now become resistance before it would actually complete its move to the downside. Part of what went into this is max pain theory. As it so happens, maximum pain for this week was sitting at just around $378 to $380 on the SPY. And this is according to MaximumPain.com, which you can actually use as a free resource to check every single day and review the open interest in the options chain for basically any ticker, but I find this particularly useful for the SPY and other major indices and ETFs, because what tends to happen on Friday is market makers will push the market in whatever direction max pain is at, and you can be almost certain that whenever max pain is extremely far away from where the stock is trading at near the day's close the day before a major options expiration, you can take a position that is at the money or very near the money from where you are currently trading at in the direction of maximum pain. The reason behind this theory and the reason why this worked for me in my trade and why I closed a trade that was up 140% today is because I looked at max pain yesterday. It read in at $380. I saw that we were trading at $370. So I took a bullish position on the SPY, even though my long-term trend and technicals were telling me that no, the market is going to go down and continue trending down for the duration of the next 2 weeks at the very least. And the reason why I inversed my own bet and the reason why I reported this to the Discord the day before was that I saw that max pain was almost 8 strikes away from where we were currently trading at, and that was something that I knew that market makers just simply couldn't sit with. So, going back to the market, let's actually look at what the long-term trend is and what this latest move means for us now. If you go down to the 30-minute chart and we start analyzing some of the peaks and resistances that we've seen so far, you'll notice that going into the Fed meeting, which we had right here, you'll see that the movement where the market was trying to push resistance and keep climbing and setting up new higher highs, we were actually setting up more bearish technicals as the RSI cooled off and set up lower highs each time the market pushed to a new peak. This culminated in the actual speech for the Fed, where on this green candle, the FOMC minute notes came out. There was huge bullish momentum, and we accurately predicted that this was a trap because there was nothing fundamental in the notes that actually indicated anything was bullish. There wasn't anything that suggested that the market was going to recover or that the Fed was going to pivot, pause, or even slow down the rate hikes. And when Jerome Powell came out onto the podium and immediately opened with, "There will be no pivot, there will be no pause, and any idea that we should do that is premature," the market immediately gave up everything that it had worked so hard to gain since the 20th of October. And this entire rally has now been essentially taken back. Now, Since we've made this large move and we have essentially formed a bear flag, a very asymmetrical structure with a few volatility pops throughout today, we can see that this is, for lack of better description, market makers and institutions that are fighting for air. It's kind of like somebody who is being pushed beneath the waves adrift in the ocean, knowing that they are going to drown, still trying to fight for those last few gasps of air. And that push is what I was counting on going into yesterday's close when I took my bullish bet. So going into this big push to the downside, I actually went long here as soon as I saw that we were tapping on resistance and the market was hesitating at these levels at around $371. Went long, and immediately upon opening the market in the morning, closed my position for a 140% profit. Now, you could have played this volatility a little bit more, but honestly, for me, looking at the market conditions and looking at the technicals, I decided that today was going to be a chop day, so I took my win and I walked away. And I didn't trade anything else for the rest of the day. However, looking closer at the technicals and the setup for the day, I'm seeing a few things that are worth calling out. For starters, we had this tweezer top that occurred here during the FOMC minutes meeting. We are all aware of this. If you look at it on the 30-minute, it's an even more obvious pattern, a more clear, objectively visible tweezer top. Over here, what we have is an inverted hammer candle near the top, followed that was preceded by an evening star. That's a doji candle that has very tall wicks on both sides, and it appears at the top of the market or the top of a trend. And typically, it also tends to occur near or at a major moving average. In this case, it occurred just above the 100 period moving average, or just below the 200 period moving average on the 10-minute chart. If you look on the 1-hour chart, you'll notice that this actually also is just below the 200 and the 100 moving averages. And what I'm seeing here is that we're now getting into dangerous territory where the 50 EMA, this green trend line, is now getting ready to meet the 200 trend line, which is, well, that is a death cross. Typically, death crosses occur on the daily time frame, which is something that we've already done a long time ago. We already completed our death cross way back earlier on in the bear market, almost 5 months ago now, back in April. But I have been watching and trading for these approaches to crossovers, especially bearish crossovers in the market, and I noticed that this last gasp, this one last little surge to get a little bit more out of the market is very characteristic of a new downtrend coming. So a big plunge is going to follow this move that we saw coming to the upside. And in just a moment, we'll take a look at some of the other technicals that help indicate this. Over here, I have a ratio chart for the SPY and HYG, that's the high yield bonds, which you can see is serving as a way to monitor the momentum of SPY versus the high-yield bonds. I've frequently heard HYG referred to as smart money because smart money invests in bonds. That's where all the institutions play, and the dumb money or the market participants play the ETFs and the SPY. So if we look at this ratio chart, we can see a few things, namely that we've had higher highs in the SPY and HYG ratio chart. We have had higher highs in the SPY, but we have had lower highs in the HYG bond market. So looking over here, we can see that we've got a few technical indicators to support the theory that we are moving into a new downtrend, big bearish territory. For one, we have multiple crossdowns, bearish crossdowns, which typically indicate sell-offs in the market. As you can see, there's been consistent selling happening in the market after these crossdowns, especially after major news events, and especially after the market has moved optimistically towards these major news events that involve the Fed. Because the fact of the matter is that the Fed hasn't pivoted. They have no intention to pivot, and they've stated this very clearly. that their mission is to get inflation under control. Now I'm going to point out two very subtle indications that something is very wrong with this move. The first is that the SPY, which you see down here in blue and yellow, is we've gotten this big sell-off after Jerome Powell basically ate the market alive. And we've had these two pops where the market was trying very hard to get above this resistance. And it briefly managed to do so in the morning, but was immediately engulfed and pushed to the downside with this big engulfing bearish candle. And then we had a V-shaped recovery with a tweezer bottom once we had established a bottom at around $370. And then the SPY pushed back above this resistance that you see here marked in the white horizontal ray. Now contrast this with HYG. You had very similar moves, with the market moving slowly upward yesterday and setting up higher lows with one big push to the upside in the morning. But when it tried to push again in the evening, we actually did not break this resistance. We closed below this line, and you can see that the wick indicates that while the push was valiant, it was unsuccessful to get the bond levels above this resistance. Because of that, we can indicate that the strength isn't there and that bulls are not actually regaining control at this point. So this slight subtle divergence tells us that while the push in the market appears to be bullish, bond traders are much more hesitant, and that tells us that institutions are much more hesitant. Next thing I want to show you guys is the Qs versus the Dow Jones Industrial Average ETF. The purpose of this chart is to show you the performance of the tech sector or the risk-on sector versus industrials, or what are considered typically defensive and more staple investor-grade stocks. So when we look at this chart, what we see is that when the market is moving up and when we are in a rallying period where everything is moving up together, the stock market rallies are led by the Qs. You can see the Qs here on this chart with the blue and yellow, and you can see the Dow Jones by itself down here in the subtle red and green. Up here is the ratio chart itself. So this is essentially the Qs divided by the Dow Jones chart. What you see is that when the market is rallying, when this is pushing, when Qs are outperforming industrials, everything is really good. And you can actually add the SPY to this, and you will see a similar correlation that whenever the SPY is pushing, everything pushes in tandem. So when you see tech leading, like you did here coming out of the COVID crash, you had a sudden surge in the entire market overall, with the ETFs that were tech heavy and risk on were all pushing things up together. And this confirmed a long-running bull market, very, very long-running bull market that went on until 2022. Up until this point, whenever we have had a major rally in the market, this bear market specifically, what we have noticed is that same principle applies, that anytime there has been a major rally in tech, there's been a rally in the SPY. And what is characteristic of this is outperformance of the Dow Jones. The Dow Jones Industrial tends to underperform the tech sector when there is a broader market rally occurring. And that's because tech is growth-oriented. It gets money fast. It's more risk on. It's more exciting. And that is part of the trading mentality that you use these charts to interpret. And then what do we notice? We have big rallies of Qs outperforming the Dow Jones here, 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 and here. And you can see this based on the steepness of the move or the rate of climb. What's different about this rally is that the Qs are underperforming the Dow Jones, and SPY is underperforming the Dow Jones. This is what's different. This indicates uncertainty. The market is very cautious and very uncertain of this latest move. If you want to be able to actually add this own ratio chart to your own charts, all you have to do is just do Qs/DIA or Qs/DJI depending on which indices you like to use. You could do SPX divided by DIA or SPX divided by DJI, whatever you want to do. There's advantages to looking at it through multiple lenses, but this is the chart that I like to use in order to view this comparison between these several different market sectors. Moving over to the dollar index with the SPY down below, we're going to inspect some of the other areas where the market has confirmed several different bottoms and look for other technical patterns that can indicate to us whether we are at a bottom or a top in the market. So what's the first thing that we see? If we look at the moving averages on this chart just by themselves, without skewing our opinion with MACD and other indicators, what do we notice? Well, the first thing that I notice is that every time we've had bounces off of the 100 period moving averages in the dollar index, we've had major sell-offs. And the 50 EMA also seems to have major significance as well. Every time that we have bounced off of this area, we've had big sell-offs in the broader market. And this has remained consistent. It's called every single top in the market consistently for the last, well, let's see. We've got 1, 2, 3, 4, 5, 6 major market sell-offs that have occurred just since January. Now, we crossed down below the market 50 period EMA in the dollar index, and then we had a big pullback that occurred several days later as a result of Jerome Powell's speech following the Fed minutes meeting. The FOMC meeting itself tells us what the Fed's objective is and what they are planning to do, which is that there's no slowdown, pause, or pivot anywhere in the near future for the market or for U.S. fiscal policy. This means that the inflation fight is still going on strong and that, honestly, the Fed is not able to beat it. For the first time, however, today we got the unemployment report, which you can see on the right, came out at an actual value of 3.7%, which was just 0.1 basis. That was 10 basis points above the expected forecast. And while this might be enough to fool some people into believing that, oh, now the Fed can pivot, now things are looking better, this is actually not the case. This is the first time that the Fed has actually gotten a print of unemployment rate increase that they wanted to see that matched up with a meet, not a drop in the inflation report. So core inflation is still coming in hot. We know that because the market completely tanked on this day and then ripped going on afterwards because of essentially the pivot rumor articles and other things going on, basically market manipulation happening that caused this market rally to occur. The unemployment rate is the only piece of good news that the Fed has gotten. And one of the key things that he said during his speech was that we need to see several consecutive prints of inflation coming down, unemployment going up, and consumer spending decreasing. And the fact is that they're not seeing that. And this is only the first. So it is not going to lead to a 50 or 25 basis point hike in December. The expectation should be that a 75 point hike will come in December as well. But this is not what market participants and institutions want the retail investor to think. So what we're seeing is banks pushing the dollar down. We're seeing the stock market get bid up, and we're seeing major institutions, especially market makers, make the market push today. And we did create a very interesting bullish pattern called an abandoned baby pattern. However, it doesn't really have true confirmation because there was no strength in this candle. It did abandon the baby, which I know how this pattern sounds. It sounds awful, but that's just what it's called. The candle that followed up did not engulf, and actually the wick of this candle intersected with the abandoned baby candle. The single candle sitting by itself was intersected by the candle that followed from today. And while the dollar is selling off, it again hasn't broken down through this 50 period EMA. It's still holding this position. Even if it closed down below, we should not jump the gun and expect a big rally in the market until we get confirmation that this is actually breaking, because what we are seeing in the market is that what we actually have is a giant bull flag on the dollar index. And this pattern has consistently led to major breakouts even after a big sell-off candle that occurred with a breakdown below the 50-period EMA. And it only took 3 days after one of these major candles pushing the market down for there to be a big recovery and a breakout of each bull flag. Every single bull flag that we have had that has touched this moving average has always led to a major sell-off in the stock market. Moving over to the VIX, there's a few other things that we should look at here as well. First of all, the VIX has been in a consolidation pattern that we actually haven't seen for quite some time. The VIX is consolidating in what is formerly known as a narrowing wedge, or a triangle if you were to extend this even farther out. However, we've also had several touches of the top on the VIX. Now, major market moves in the VIX are characterized by these triangle patterns, and especially once the breakouts of these triangle patterns play out. Typically, they're a bit flatter, but we've been in some pretty extraordinary times where the market has been especially volatile, moving up and down by huge margins over the course of time. Now, if we look at the state of the market, we can begin to notice that the bottom trend line of the VIX is very significant. The bottom trend line of this narrowing channel is significant. Every time we've touched it, there's been a sell-off in the market that followed shortly thereafter. And this is on a daily chart, so bear with me. But after successive touches of this particular trend line, lower or higher lows on the VIX, we get a big move to the downside in the market. We had another one here where we touched a 200 daily moving average. We had another one here where we had a two-touch double bottom pattern in the VIX. This signaled a top in the market, and as the VIX climbed, the S&P sold off. We had a consolidation diamond bottom pattern that occurred down here in the VIX in mid-August, and that also signaled a major top in the market. And then we had a 1, 2, and now we are approaching a third step in our chart where the VIX is creating higher lows. Now we need to wait for a confirmation candle to indicate that we have established a third higher low in this chart pattern. We have 1, 2, and now we're waiting on a third with a big tall green candle in the VIX to confirm where the bottom is in the VIX. But the thing to note here is that we've had major consolidation in the VIX, culminating in this bullish cross up on the MACD. And this indicator is especially important for the VIX because these crosses on the VIX are so significant. They have called every single top and bottom in this market consistently. Every crossover on the VIX coincides with major tops and bottoms in the market. We had a bullish cross on the VIX. We get bearish crosses on the SPY a few days later. There's always a 1 to 2 day lag in the movement unless the VIX shoots up almost like a rocket straight up into the sky that forces the fear just forces the S&P to collapse. And interestingly enough, if you were to go all the way back to all the previous moves for the VIX, every time that the VIX has been in this major pullback that had us approaching the 30 line, which is the oversold line on the RSI, you see that there's a big surge with some of the biggest downtrend sell-offs happening in the market shortly thereafter. And it's always preceded by a bullish cross on the MACD with the price cloud oscillator outside of the price cloud. A little bit of background on this particular indicator. This is a MACD indicator, but specifically this is called the price clouds oscillator, created by the Peaceful Lizard, who's actually now a member of our Discord. Shout out to Peaceful Lizard for joining the Hell's Trading Floor community and helping us out with understanding these indicators and even coding a few for us huge shout out, dude. We really appreciate you. But in any case, what I have noticed is that every single time this price cloud oscillator touches outside of the or the MACD crosses outside of the price cloud, this indicates major sell-offs. So you notice that it touches outside, but it's very rare that we get a bullish cross that happens outside. So we've had these touches, 1, 2, 3 touch, but this is unique. We've had a bullish cross that occurred outside of the price cloud. That's what's different about this particular move. And we only had one of these particular moves that happened so far in this bear market, and that was in March of 2022. March 2022, when the RSI had touched the 30 line, we had a bullish cross on the MACD outside of this price cloud oscillator. And this actually signaled exactly the bottom in the VIX for the entirety of the quarter, and it signaled the top of the market for the entirety of the quarter. And the market did not have 2 consecutive green days in a row until May, a full month later. I actually went and zoomed in. As I mentioned, the cross here that happened outside of the price cloud oscillator, there's one that just barely happened outside here at this level. And that was actually at the bottom of the VIX on the 8th of June. And that was the last day that you had the opportunity to exit the SPY before we had this major move to the downside where the market moved down 13% in the SPY in just 9 trading days. So what does all of this mean for everybody who's currently trading the market that's looking for guidance for what's about to happen next? My fear here is that we are actually forming a new top in the market, very similar to what we saw in times such as these. However, the bearishness of this particular crossover leads me to believe that the following move may be so extreme that we could see the SPY actually take out the previous low that we had this past October. If that is the case, then it is reasonable to assume that we could see lows as far down as 320 on the SPY this month. For that reason, I am continuing to stay short on the market. I will maintain my positions and I will keep everybody in the trading floor up to date as to what I believe is going on. But as far as I can see, as far as all of the technicals have spoken to me and what I've been able to discern from all of the different indicators that I've shown you here today, is that we are far from out of the woods. The bears have us in checkmate. There is no way for the bulls to recover back to these levels like they wanted to believe. And I feel that we are just now on the very cusp of a major market sell-off that may dwarf what we saw back in March. The last thing I'll leave you with is just a little bit of guidance of where we're going to go next. So first, I'm going to clear off this chart. We don't need max pain anymore. We already know that this played out to our favor, and this is exactly what we expected to happen today. Where are we going next? So first off, the overall pattern of this entire market, which we just realized now after seeing the reaction from the market today and the last 2 days, is that we actually have printed a head and shoulders. So the head and shoulders pattern is a classic bearish continuation pattern or a bearish reversal pattern indicating that the market is no longer accepting highs. What happened is we had a bottom that occurred in late May. We had a rapid recovery, a diamond top pattern that had completed and moved massively to the downside, and we had established a floor right here. The market moved back up to this new level, and then as soon as CPI print dashed all hopes and dreams of the bulls, the market slammed back to the downside all throughout the rest of August and September and into late October, when we finally printed the lowest low on the 12th or the 13th of October with the latest CPI print, and then had one more bounce fueled by rumors and rumors only of a Fed pivot, which proved false. And as soon as the Fed had come out and stated very plainly there will be no pivot, the market has started moving to the downside. And so far, this prints a head and shoulder. Going further into this, how do we actually measure the move here? There's two ways to do it. Typically, two ways to set up a take profit is to estimate the distance between the top of the shoulder and the lowest low from the first shoulder. And you can use this as a measuring stick from the break of the neckline to indicate the lowest low. I feel as though this is a little bit optimistic, and it's worth mentioning that this head and shoulders pattern is askew because of the overall direction of the market. If you kind of look at this with a little bit of a tilt, then you can see it more clearly, but this does make it a little bit difficult to measure the move. And honestly, I think that it would be a bit optimistic to believe that the neckline break down here at 340, which would already be a massive move, would immediately lead to a sell-off to 285. That seems a bit out of reach. Instead, what I'll be doing is I'll be using a more classic indicator based off of the move from the top of the head to the bottom of the neckline, and then I will set up a breakout of the bear flag. One thing that is very characteristic of head and shoulders patterns is that the last head and shoulder, those down slopes, always form a bear flag. To do this, take a trend line from the top of the head down to the lowest low, form your bear flag, which in this case is actually a bearish pennant. You can draw this by going across the tops of the highs and the highs of the low points. We've already had a breakdown that occurred during the FOMC meeting and the speech that followed. This broke this bear pennant. So we've had a breakout down here, right smack down on the 50-period daily moving average. How do you take a measurement of this? Quite simply, take a copy of the flagpole and drag it down to the breakout point. As soon as you see that breakout point, mark your low, and there is your price target, just below 300. I still feel as though this is a bit optimistic, but it does match up with my thesis that when the market finally does reach a final support before the crash, that it will most likely undercut it slightly and then try to find support for one more rally, possibly a rally going into Christmas and January before the market finally meets its final resistance and we see yet one last capitulation that will return us down to either the capitulation level of 260 or even further below at the lows of the COVID crash. While admittedly a very dramatic chart that is certainly not drawn to scale, and this is absolutely not a prediction of what will happen, merely speculation of what may happen, it is very worth it to take stock of how far we've already fallen in this crash and know that we are still not done. The average bear market results in anywhere from a 30 to a 50% decline, especially during a bubble. Bear markets are extremely aggressive and they take back everything that was given to traders throughout them. And frequently, traders make their plays wrong. It's far better if you are not an active trader and you are not familiar with trading a bear market to simply stay out. But if you're determined to learn and this is what you want to do, then I would encourage you to consider joining Hell's Trading Floor. Hell's Trading Floor is an open community of investors and experienced traders, also trying to teach other inexperienced and beginner traders. If you're just now starting out your trading journey, I would encourage you to consider joining us at hellstradingfloor.com, where you can join our Discord at discord.gg/hellstradingfloor. And I'll take this time to shout out to ADHD for the win, aka Boomer Assassins, who's been a member of the trading floor for many months now, been here almost since the very beginning, who posted his full week of extremely profitable trades. Shout out to you, dude. All the credit goes out to you for all of these amazing wins. 91%, 38%, 70%, 60%, and even several triple bagger and double bagger plays that I see 350 and 200% wins, all within one trading week. That is a fantastic win rate, and I'm so proud of you. Boomer Assassins came to us as a newer trader, and I'm so proud to see the improvement in him and all the other members of the Hell's Trading Floor that have really come a long way and learned how to read the market and make it work for them. Anybody who's interested in joining Hell's Trading Floor is welcome to sign up for a 7-day free trial where you can introduce yourself to the trading community, get familiar with the way that we work and the way that we teach, and meet some really great experienced traders, get your questions answered, and start learning how to do real technical analysis and fundamental analysis to predict the market moves before they happen. There are a lot of ups and downs in this market, and it's been a hell of a ride. We're certainly not done yet, and there's definitely way more to be made yet. So if you are new to trading and you're thinking that this is too hard, that this is too complicated, that the market just does whatever it decides to do, and it always decides to take what I make, don't think that way. The market is a vehicle for transferring wealth from the impatient to the patient. And if you can be patient enough to teach yourself how to become a truly good trader, then there is no limit to the amount of wins and the gains that you can see come back and reward you for all of your hard work. That's going to be it for this video. Thank you guys so much for watching, and I look forward to seeing you next time. Until then, have a hell of a time in the markets. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.